The road to recession. The inverted bond market now has a message for us, but we've been here before. We're going to talk about what is an inverted bond market, what is now our likely path, and what is the actual market signal? What's the trigger that we're looking for? Well, the 1 year treasury yield is shown here in yellow, the 10-year in blue. The white area chart below is the spread between the two maturities. Now, normally those treasury bonds with longer term maturities tend to have a higher yield, but in an inverted bond market condition, the short term maturity, in this case the 1 year bond, is above the 10-year. Now, this all began around June of 2022 when the 1 year crossed above the 10-year. And we can see over time what has happened. The 10-year has actually fallen compared to the 1 year, and that spread has widened, again, in negative territory. More recently, we see the spread has now decreased, still in negative territory, as the 10-year remains below the 1 year. Now, what is the connection between the 10-1 spread and the stock market? And it's a very specific correlation. It's actually an inverse correlation. Stocks tend to go down when the 10-1 spread increases or rises, I should say. But when it decreases, when it widens to the downside, when the 10 falls deeper below the 1, the stock market actually likes that. More recently, we can see what has happened. The 10-1 spread is falling. Again, what's happening here is the 10-year treasury yield is falling more than the 1 year. And the stock market, the yellow line, S&P 500, is rising. Why? The stock market likes the expectation of lower interest rates in the future. And when the 10-year falls, it's telling us that the expectation is over the long term that interest rates will be lower. We're going to look at just a moment the mechanics of exactly how this works. This is the performance of the Treasury market since the last Federal Reserve meeting in May. And we can see specifically the longer term maturities, the 5, 7, 10s, medium to long term, they've fallen a lot more than the short term. And that's why that spread is declining. That's why this blue line on the right-hand side is declining, because the longer term maturities are falling more than the short term. Yellow line again, S&P 500. The stock market likes the expectation that over the long term, interest rates will be lower. Now, what exactly is the bond market telling us? Short-term maturities. They tell us the near-term expectation as far as interest rates. What will the Federal Reserve do today, tomorrow, a week, maybe 6 months from now? Longer-term maturities tell us the expectation for long-term economic growth. How strong or weak will the economy be 5 or 10 years from now? Now, we see here, this is the performance since the last Federal Reserve meeting in May. Short-term maturities since the last Fed meeting have fallen, but only moderately. Long-term maturities have fallen to a greater extent. The expectation is over the long term, the economic growth is going to cool. And this is why the inverted bond market is not something we want to see. Not every inverted bond market predicts a recession, but every deep recession has been preceded by an inverted bond market, because the inverted bond market occurs when the short-term interest rates are high and the expectation for long-term economic growth is sour, is falling. Sounds familiar. It's kind of like what we're going through right now. Well, there's two stages, we like to say. Stage one, this is a setup. This occurs when the inverted bond market has a declining 10-year yield. The 10-year bond yield is falling. That has been the case since the last Fed meeting. Interest rates in the near term remain high, but the economy, the foundation underneath, begins to cool. Stage one, we see, occurred back in 2007. This occurs when, again, the 1 year yield in yellow is above the 10-year in blue, and we see the inversion began to deepen. The long-term expectation was, at the time, that the economy was cooling. But in the short term, the Federal Reserve really didn't have any plans to cut interest rates. This occurred again late 06, early 07. Stage two, the crisis begins. That is triggered when the 1 year yield collapses. Then stocks follow. We'll show you exactly how the stock market behaved then and what we think it may do now. Here's a 1-year yield again in yellow, 10-year in blue, and notice what happened. The inverted bond market condition went away. The 1-year crossed back below the 10-year. Unfortunately, the way it happened is the problem. The 1-year collapsed below the 10-year. 1-year yields decline before the stock market. If we're ever looking for a signal to predict where the stock market may go, this is probably a very, very important signal to look for. The 1-year yield in yellow. Notice what happened. The 1-year collapsed months and months before the stock market began to really decline. Now, yeah, the stock market was weakening, but not to the same extent. For those of us watching the 1-year yield, we had quite a bit of time to see this decline before the stock market sell-off really took hold in 2008. Well, where are we now? S&P 500 in yellow, the 10-1 spread in blue. This we know. What's happening at the moment is a 10-1 spread is continuing to widen as stocks continue to move higher. The stock market, in part, is moving higher in anticipation of lower interest rates. Now, here we see the probability of no change in interest rates. This is the Fed funds futures. In red, these are the probabilities for the June meeting. We have much greater than a 50% chance that the Federal Reserve is not going to cut rates in June. In yellow, we see July, September, November, and December accordingly. Notice the divergence, though. The red line is much higher than the rest of the meetings, meaning there's a much greater expectation of Federal Reserve, almost a certainty, the Federal Reserve's not going to cut rates in June. Not so much, though, in the other meetings. And notice this spike in the red line in particular, all the meetings really, but in particular the red line, that occurred as a result of the FOMC meeting. That's our last Fed meeting in May. Now, what the result of that, and we spoke about it here as well, is that the Federal Reserve basically alluded to the fact that maybe, we're not going to cut rates unless we start to see signs of a crisis, specifically in the jobs market. Well, the last non-farm payroll number, and we spoke about that here as well, that was not so good. And maybe that gave us reason to think that the Federal Reserve is going to cut rates sooner than previously expected. This was in Yahoo Finance Today. It's kind of a long article, but there was something in particular that we found pretty interesting. Investors started the year cheering the data as they priced in a soft landing for the U.S. economy, where inflation would return to the Fed's 2% target without an economic downturn. There's terms that we talk about here: soft landing and hard landing. A soft landing is when inflation cools, but the economy is still strong. That's the best of all cases. A hard landing is when the economy really kind of crashes before inflation comes down. Well, they said here, but after recent hot inflation data, meaning inflation's not coming down, markets have been more skittish as investors have increasingly priced in no landing, where inflation does not come down to the Fed's target, but the economy keeps on growing. See, here we've reached a dichotomy where good news is now bad news. This has led to the market perceiving good economic news to be bad news for inflation, and therefore bad for the market's rate cut hopes. You see, now when we see a good economic number, like good manufacturing number or a good jobs number, now the market's thinking, uh-oh, that's good. That's going to lead to more inflation. More jobs, more inflation, more manufacturing, more inflation. So now the market's cringing under new good news. This suggests hot macro data has increasingly threatened the soft landing narrative that may be needed to push markets higher from these elevated valuation levels. See, it's just a matter of time before these very high interest rates really start to drag down the economy. We would hope the economy would slow down gradually. Inflation would come down gradually. In other words, a soft landing. But we're not seeing a slowdown, especially in inflation. Why is all this important? This week's economic calendar is probably more relevant to this discussion than any other in quite a while. We have inflation data, consumer price index, producer price index. We also have growth data. Among other numbers, we have manufacturing, a lot of manufacturing data this week. Empire States, that's in New York, Philly Fed, industrial production and capacity utilization. Lately, the manufacturing data has actually started to look better as well. What are we watching specifically? If inflation is hot this week, PPI and CPI, if those short term yields rise or remain strong, that's telling us inflation is stickier than ever. If growth cools, meaning manufacturing data, let's say, comes in soft, long term yields may decline. Remember, again, long term yields, expectation of long term economic growth. If manufacturing looks like it's declining, then certainly we could see long-term yields sell off. Now, the worst of both cases is if inflation is hot and manufacturing cools. Long and short-term yields determine ultimately whether we have a hard or soft landing. We had a question earlier this week, which was very apropos. We are actually in the process of preparing this presentation right now. Perfect timing for this question. Do you think the inverted curve is still an accurate indicator, or is it this time is it different? Well, personally, I don't think it's different because the inverted bond market is telling us something. It's telling us we have in the near term short-term interest rates are high. We know that. Interest rates, we've watched them go up. Long-term economic prospects are cooling. We have lots of evidence of that. The last GDP number, the last employment number. We actually took a deep dive into the employment data. It's not just the non-farm payrolls. It's ADP. It's the JOLTS report. There's a lot of data that points to cooling in the economy. At the same time, hot inflation. So we have an inverted bond market. Again, not every inverted bond market leads necessarily to a recession, but every recession has been preceded by an inverted bond market. How we come out of this, a hard landing versus soft landing? Well, a soft landing is if inflation cools and the jobs market is still relatively strong and manufacturing and growth and GDP and all that other good stuff is still strong. Is that likely? Are we on the road to recession? If we had to guess, well, we're not pointing in the right direction. Are we on the road to recession? We're not on the right road right now. We're already seeing signs of cooling data and hot inflation. We could always see a turnaround. It's not written in stone, but we're not on the right path right now. It's all a question of inflation versus growth. Which cools? If inflation can cool with strong growth, that's good. But we see the opposite right now. By the way, this is not all that's going on. We also pointed out recently 3 examples of repeating market cycles. Very uncanny what's going on, and we cover that in quite a bit of detail, and I think you'll find what we discovered here to be quite interesting.